My very special guest today is going to help you see the financial industry in such a different light that you're not only going to be able to reach your financial goals, but also have financial freedom. Now, if that's something you want, stay tuned until after the music. You're about to listen to a great episode of the Laz and B Experience podcast. Within this episode, my hope is that you obtain something that will help you find your success. So grab a pen, get your paper, your favorite snack or drink, and really listen to what I have to say. I truly believe it can be what you need to get you to your next level in life. So grab a seat and enjoy the ride, and I'll see you on the other side. Welcome back to another episode of the Laz and B Experience podcast. Thank you all for listening. This could be another great episode, especially for those who are trying to build wealth within their family and figure out how they can use credit and use the banking system to do so. So I do have a special guest with me today. As I always say, all my guests are special because I picked them out specifically because I feel they are very knowledgeable about the topics that we're going to be talking about. So today I have a guest that I've known for quite a few years now. We both went to the same high school, and I don't know what episode this is going to be coming out in, but as you can probably notice, all of my guests are people I've known in the past in some form or fashion, whether it's from high school or it's from college or from organizations I'm a part of. So if you're just a small tip before we even begin this episode, if you're trying to start your own podcast or have guests, that's a great place to start, is your network that you currently have. So thought I would just bring that up. But like I said, I have a great guest today. And without further ado, I would like to introduce my guest, Alex Rubio. How are you doing today?
Oh, my goodness. Thank you so much for the invitation. Thank you for that warm introduction. I'm doing pretty good, brother. How you feeling?
I'm doing pretty good. I've been pretty busy this week doing a lot of interviews, but they all been good. It's been a good time. I've been enjoying it. They've been enjoying it. I just feel like it's a good feeling when both people feel like they're getting something out of the situation. So I've been feeling good lately.
Good. I'm happy to hear it, and I'm happy to be here. So thank you again for the invitation, bro. I really appreciate it. It's my first podcast ever. So I'm super excited.
Yeah, definitely.
And a lot of people dressed up and everything too. I suited up. Like, is this a podcast, just audio or video? I'm prepared for both. So
yeah. A lot of people that I've been interviewing, this is their first interview. So I feel like that would also play a good part into it, because if someone is giving them a chance to talk about themselves, why wouldn't they want to do it? So I think it's the best of both worlds. So let's get started. If you couldn't tell by the title of this episode, we'll be talking about credit and banking and how you can use that to build generational wealth and find your success. So let's start with the first question. If you can, just tell us a little bit about yourself and how and why you are, I guess, the expert when it comes to credit and banking.
Cool. So first things first, I'm not a guru. I just want to say that out there right now. But I've been around a few times when it comes to being around the block. So my thing is, I learned through experience and trial and error. So being introduced to the banking system at the age of 18, 19, that's when I kind of got my foot in the door. But for those who don't know me, I go by the Credit Banker on Instagram. And on Facebook, you can find me, Alex Rubio. And I repeat that at the end too, just so if people want to find me, they can.
Definitely.
But I'm 28 years old. I'm a branch manager at a small but yet up and coming bank in Chicago or in Illinois. So that's a huge accomplishment for me.
Definitely.
Hit
28
by 30.
Yeah.
When it happened, I was like, oh my goodness, I can't believe I made it. But yet I'm still hungry, but yet I'm still humble. And I still have a ton of room for growth. So I'm a branch manager at a bank. Been in banking, kind of weird to say, for about almost 10 years.
Did you go to school for banking?
Didn't go to school for banking at all. Yeah. And what's surprising is people think I have a degree, and I don't.
Okay.
Yeah. So that's one thing that kind of stands out for me is I use my resources pretty well. I'm not saying you don't need to go to school, or you have to go to school. You don't, whatever the case is. But there sometimes are ways to kind of get around it. But not going to school does and can limit you, especially on paper. But I don't have a degree, but I did go to DePaul briefly. But that didn't really work out for me with what I wanted to do, especially being in high school and skipping a few years and then going back to college, new when it comes to being a full-time employee. I was a new full-time employee, then jumped full-time in school. I was like, oh my God, what did I just get myself into? So, but I got into credit young because I have a unique perspective when it comes to being introduced to credit. I didn't get to mess up my credit the traditional way. Usually you go to school, they get you a college credit card, $1,000 limit, and you get to mess it up that way. You ain't got no job, and you max it out, you don't pay it back.
Yeah.
And now you're screwed. So for me, when I was 18, I was playing basketball, and I thought I was D Rose. I had my D Roses on, and I'm trying to hoop, and I end up spraining my ankle so bad that I end up going to the hospital. And at that time, I was working a part-time job, scooping ice cream. I had just graduated high school, and I didn't have no insurance because I was 18, and I, got off the family plan when it comes to like the government assistance. So I banged my ankle pretty bad, and next thing you know, I'm getting calls, I'm getting letters. It's like, what are all these calls? What are these letters? Oh, how much from going to the emergency room? Like, oh my goodness, it was only a block from the LA Fitness, and that's when I knew that I kind of messed up. I didn't have no insurance, no money, no credit, and now it's like a year after. I'm trying to work on building my credit. Like, I'm 19 now. I want to build my credit. I couldn't get approved for anything, and figure out I had collections on my credit, like several collections, a few $1,000s, and so I had to learn the opposite way to build my credit, from digging out the hole that was already created for me by having that collection on my credit report. So that's why I have like a unique perspective on credit, because I messed it up without messing it up originally, and then I had to work my way out of it. And then being at the bank, there's so many people that don't know. So many, regardless of age, there's so many people that don't know. So I have a unique viewpoint on it, and I have a privilege to share this information with people, regardless if they do anything at the bank or not. And that's why I started my credit repair company, was because I can't really help people on the banking level because a conflict of interest, So I started something separately with people that aren't really affiliated with the bank who need help. And what's unique about my program is it's not just credit repair. I do financial coaching as well too. Okay. And people think financial coaching and like financial advisor are the same thing. They're two completely separate things. With the financial advisor, they're more catered to helping you grow your money and invest. Okay. You have people who can't save a dime, and that's why they need a financial coach. Okay. And that's where I kind of come in as well too. So with the financial coaching, I teach people and couples how to work with their money, especially together, cohesively, because I think of it like people trying to row a boat. You got a new couple, they're married, they're rowing a boat. One is going this way, one's going that way, and they're just going in a circle and not going anywhere. Yep. And too many times I see people sneak into the bank, open up a separate checking account, trying to hide money from their spouse. Like, look, no judgment out there for those who do that. But I've seen the dangers of doing that, and there are right ways to do it.
Yeah, I feel like, it's okay to have a separate account away from your spouse or your significant other, but it's that communication part where like they both know that we both have our separate account, and they know where the money is going and where it's coming from.
Exactly. Yeah. I can go over that now or later on in a podcast, but there are certain ways to do it, just like you said. So the way we have it in my household, all the money goes into one pot, into one account. She has her separate account, I have my separate account, and that's where we budget where we're going to send our fund money. Like, all right, this is my $100, this is my $200. You can't tell me what to do with it. It's mine. It's going to my account, and I can use it for wherever I want to, but it's on paper, and you're telling your money what to do.
Exactly.
Before your problems tell you what to do with your money.
Exactly. I like that. Yeah. But you was talking about credit earlier. So what is credit, and then like what can it be used for?
It's like an excellent question. So basically, when it comes to what credit is, it's the ability to borrow someone else's money. You can have good credit, you can have bad credit, but it's the ability to borrow for whatever item or necessity. And there are multiple different types of loans or credit cards out there, including mortgages. So you're trying to get a house. Okay, you don't have $300,000, especially not right now, to buy a house that's over what the market was before. So you need credit to essentially get you closer to that goal. Same thing with a car. You want to buy a car, you can do it cash, which is great, which is what I recommend. But sometimes people want, more luxurious cars, right? Same thing with like equipment for the podcast. You can use your cash, but there's other ways to do it as well too. Not only in your personal, but on business credit as well. So,
go ahead.
Yeah. So basically, business credit is the ability to borrow someone else's money.
So when it comes to credit scores, like what would you consider a bad credit score? What would you consider a good credit score?
That's an excellent question. And working at the bank, I've seen so many credit reports, and I analyze them and study those who have great scores and those who have low or no scores. Just to quickly answer the question, a bad score, a good score is a 720.
Okay.
A 720 will kind of get you in the door wherever you are.
Okay.
Now, if you are in the mid 600s, that's not a bad score. That's like an average. But you still can be declined for certain loans, or your interest rate will be higher. But that 720 up will kind of get you in the door with the best interest rates. Like you see these commercials all the time. Hey, cash down, 0% APR or 2% APR, whatever the case is. Those are for those people who have the better credit, not just for anyone watching the commercial. The question about, or the thing about bad credit is, I've seen credit reports. And this is where I'm going to break down like the differences between certain credit algorithms.
Okay.
You have the FICO, which 90% of banks use, and then you have the Vantage. For those who are using Credit Karma, Credit Sesame, Credit Wise to the banks, all these other credit monitoring companies, look to see what they're powered by. Like, what I mean by that is usually you see it's a powered by Vantage 3.0 or powered by FICO.
Okay.
That plays a huge part in what your score is.
Okay.
Because people say, oh, Credit Karma score is not accurate. It's accurate. It's just telling you right there in the front page that, it's a different type of credit score. And banks don't really use that. So I've seen people who have no FICO score at all. I'm talking like you run the report, literally nothing shows, but yet they have a Vantage score, which is weird. And banks don't really use Vantage score. So in order to get a Vantage score, you just need to open up an account, have it for a month, and then boom, you're there. All right. Versus for those who are really trying to build their credit, you don't generate a FICO score until you have at least 6 months of activity on an account. So someone new, hey, I just got a new car, I just got my first credit card. You're not going to generate a FICO score until you have that account for at least 6 months. But I've seen bad credit scores as well. The lowest score I've seen was like in the 400s, But the credit score range goes from 300, meaning the lowest, to 850. And for those who don't have a credit score, that's a good thing because you really have like a blank canvas, and you can start creating those positive habits to build your score the right way.
Yeah. So have you ever seen somebody with you said 850 is the highest?
I've seen literally this happened about 2 months ago. I was so surprised. I was going through the reports over the branch. I was like, there has to be an error. I'm looking at the score. It said 850. I've been in banking for, like I said, 10 plus years. I've never seen a perfect 850 credit score. And some of the things I noticed in that report was how long they've had their accounts. So the age plays a huge factor. So the longer you keep an account, the better, as well as the amount of accounts they had. And the biggest piece was the utilization piece. What utilization is how much credit do you have? Like, let's say you have a $100 limit, and then how much are you using? So are you using the full $100 and maxing it out, which means you're gonna hurt yourself, or are you utilizing 30% or under? Now, with the reports that I've seen that are for those who have higher credit scores, they don't even use 30%. They use about 10 to 15%. The difference is they have $20,000 limits on their credit cards, right? versus some of us starting off might have a $200, $300 limit.
Yeah.
And it's harder to use only 10%. When you go to the gas station, that's $100 right there, and you almost maxed out, you know? So that's one of the biggest things I've seen with those who have a high credit score is the age, the utilization, and then the number of accounts. They usually have several.
So you was also saying that with Credit Karma, their credit score might not be as accurate as the one you would pull whenever someone's trying to get a loan to get a mortgage or whatever. What source or what resource can someone go to get the most accurate credit score for themselves so they can be more prepared before they go to a bank?
That's an excellent question. So you need to know the freeways as well as the non-freeways. When it comes to if you just want to access your report just to look at the accuracy, annualcreditreport.com. Literally once a year, you can pull your report from all three of the credit bureaus right there, and it will give you your full breakdown of your credit report. It won't give you your score. It will give you your report. Okay. Now, because of COVID, what's crazy is they give this, instead of annually, it's weekly. So you can pull your report every week if you wanted to. Especially for those who are working on their credit, like if they have a collection, they're paying it off, or whatever the case is, disputing it, and they want to, be aggressive with monitoring it. That's the way to do it. Now, when it comes to the actual score, or seeing the actual FICO score, I personally use MyFICO. Okay. MyFICO.com. There's an app. MyFICO is expensive, but it gives you the most accurate score. And what I mean by that is, you don't just have one credit score. And for those who don't know, there are 3 credit bureaus. You have TransUnion, Equifax, and Experian. When you go on Credit Karma, you get to see TransUnion and Equifax. You have to download the Experian app separately. So now you have 2 companies looking at your credit, and you don't have the full picture. But with the MyFICO app, it breaks down everything. And what I mean by that is, you have a different credit score when you try to buy a house. You have a different credit score when you try to buy a car.
Okay, I didn't know that.
You have a different credit score when you run your credit at a bank just for a traditional loan. Even for a credit card, you have a separate FICO score. And there are different FICO algorithms that tell you or are judged on that specific industry type. So, hey, what are the chances of him paying back this mortgage? What are the chances of him paying back this car loan? What are the chances of paying back this credit card, and et cetera? So they're all calculated differently, and they vary based on what you have on your credit report. So it's so important to have a nice credit mix. You don't want to have all credit cards or only one credit card and no loans, or all loans and no credit cards. You're really going to be hurting yourself because you're not fully utilizing the full credit spectrum.
Okay. Yeah, definitely. I never knew that. So something I learned, and I always learn something new with all these episodes. But let's get into, let's say someone has a bad credit score, or someone who has a good credit score. How can that person who has that bad credit score increase their credit score, and how can that person who has a pretty decent credit score maintain with that good credit score?
Good. So we'll start with the bad credit. If you have bad credit or no credit, the first thing you have to do is start. If you had late payments in the past, those late payments, the older you get away from them, the less they have effect. Same thing with bankruptcy, same thing with collections. The older they are, the less effect they have versus when they first get implemented on your credit report. Now, if you're at a clean slate and you have no credit and you want to start, what's going to happen is when you go to a bank and you try to apply for a credit card, 9 times out of 10, you're going to get declined every time. And that's what happened to me. Mind you, I had worked, I'm not going to say the name of the bank. So I'm not going to do that. But I had worked at my second banking job. I was a teller. I had just got a car, so my credit was starting to get there, after my stunt with the collections from the medical bill. And I'm working at this company. I'm applying for a credit card with the banker, and I'm getting declined every time. And all I'm getting from the banker was, hey, try again in 6 months or whatever. Try again. They're going to get a letter, friend, whatever. Like, man, I know what's going to happen. I know what's not going to happen is it's not going to be a credit card in the mail. So for those who are trying to build their credit, what you have to do is utilize something called secured credit cards. So there's secured and there's unsecured. Unsecured meaning, hey, I want a credit card. You apply, you look at your income and your credit, boom, approved or declined. Secured means, hey, I'm going to give you collateral, which means if I don't pay this back, you can take the money I gave you. And usually they start with like $99 or $200. The bank I'm at now does $300 as a minimum. So meaning you need to bring $300. The bank is going to hold that money. You can't use that cash, but they're going to give you a credit card with that limit. Mm-hmm. Now, there are certain banks out there that will review your credit report in 6 months of you having that card, and they will give you an increase and give you back your refund. Okay. So that money that you put down is refundable. So that's an easy way for you to force a bank to give you a credit card. Now, just the same way you do a credit card, you can do that in the form of a loan too. So you can give the bank a large deposit, and they will hold that, give it to you in the form of a loan, which sounds kind of weird, and then you can use that to have it repay itself back. So now you are mixing up your credit report with revolving, which is credit cards. You want to have a nice mix of revolving accounts, and then you want to have a nice mix of installments or loans. So that's an easy way for someone who has no credit to start. In addition to, if you have family members who have good credit cards or good credit scores, they can add you as an authorized user. What that means is that information on that specific account or trade line will show on your credit report. Now, that does help you. Sometimes it can hurt you. So if that person has a great credit card, and they're using it, and something happened when they don't pay it, it hurts you. Mm-hmm. Versus when they pay it, it helps you. Another thing too is certain banks have different credit guidelines. So having a credit score is great, but certain banks want to look at how many trade lines you have. And what a trade line is an account that you pay on that's on your credit report. Okay. So usually people, you hear them say like, hey, I got authorized trade lines, or I got trade lines, meaning they have an account that they can put on your credit report. But if you're an authorized user, it's not counted as a full trade line on your credit report. So even though it's helping your credit score and it's benefiting your report, if the bank needs to see 6 trade lines or 6 accounts, and you have 6 trade lines that are, 5 are yours and 1 authorized user account, you can get declined because you're not obligated to pay. Mm-hmm. So hopefully that answers your question on how to build credit. Now, for those who already have good credit reports or good credit scores, one of the easiest things they can do to build their credit even higher is to get limit increases on their current credit cards. Because like I said, that a big piece of the credit pie is, the 30% of utilization, mm-hmm. right? That literally is a piece of the pie, 30% of utilization, how much you're using on your cards versus what your limits are. If you have a company for 5 years and they only gave you $2,000 and you never missed a payment, ask them if they can increase your limit. 9 times out of 10, if you owe a small balance or none, but you actively use the card, they give you an increase. Like I had a credit card I had when I was, I think, 20 years old. I went to a glasses store to buy some glasses. Turns out the glasses were more expensive than what I thought at 20, right? So I was like, okay, well, is there any way I can buy these glasses today? And they offered me the Care credit card. And I started off with a $500 limit. To this day, every few months I would ask for an increase. An important thing to note about asking for an increase is to make sure that they won't run your credit again. So certain companies run your credit every time you ask for an increase. Certain companies just go based off of your history with them or your relationship with them. But also they might do like a soft pull. And a soft pull doesn't affect your credit report. A hard pull does, just FYI. They did a soft pull. They gave me $2,000. A few months again, I used it, paid it back. Same thing, $5,000. And the biggest jump I got was from $5,000 to $15,000. Boom. I was like, oh my goodness. And that did wonders for my credit report. So now if I use $200 versus when it was a $500 limit, I'm almost maxed out. Versus $15,000, use, a few $100, I'm still in a very low percentile of the credit utilization. So that's the easiest thing you can do. If you have good credit and you have credit cards already established, ask for increases. Make sure that they would not run your credit.
Do like paying your rent or your utility bills, do those have anything to do with your credit or your credit score?
It depends.
Okay.
That's a good question. So sometimes at the bank, I get parents to come in, with their grown kid now, and they're like, oh, they have good credit. They pay their cell phone bill and they pay their ComEd. I'm like, okay, that's good. But it ain't got nothing to do with their credit, right? The only way, there are two ways that can go on your credit report. If you don't pay them, and it's a collection, that's the quickest way, right? But now you have companies like Experian Boost, who look at certain type of accounts and will add that history to that type of utility to your credit report, which will help you. But that's with Experian, so the other two credit bureaus won't be affected. Secondly, when it comes to paying rent, there are companies out there like Rent Track, Rent Reporters that actively help you report your rent to your credit report, which is dope. So if you don't have no credit, but you've been paying rent for the same place for 2 years, I just gave you an easy way to build your 2 years worth of credit right there. So Rent Track, Rent Reporters, there's others out there. Just Google how to build credit with paying rent, whatever. So that's a good way to do it as well too. So other than that, no, there's no other way to do it.
Yeah. So before I go to the next question, I did want to make a disclaimer that these tips only work if you're managing your money correctly.
Thank you for saying that.
Like, just because you have a credit card with a good limit, or just because, I don't know, you have a good credit score, if you're not managing your money correctly, like, it can definitely decrease your credit score. It can make it harder for you. So take these tips and definitely use them, but make sure you're like managing your money good before you start worrying about getting a credit card or getting personal loans and stuff like that. And I have mentioned this before, so if you're trying to figure out how to manage your budget or manage your money, I have episodes in the past. My first season, I have an episode about budgeting. This season, I also have another episode about budgeting. So if you need help with that, you can definitely look at those episodes as well.
And that's really important. And that's why I don't only do credit repair, and that's why I do financial coaching, because I find that people aren't eligible for my credit repair program. Meaning, I ask you a few questions before I onboard you to the program. Have you made a late payment in the past 90 days? Yeah. Okay. Then you're not eligible, because now with me helping you build your credit and you having late payments, now we're not working together. With like ice and fire. When it comes to the financial coaching program, that's where I do help people create a budget on paper, and then I kind of coach them when it comes to what are the needs versus the wants. And that's a really, really touchy subject for a lot of people. For me personally, I need my $50 haircut. It's like, okay, I need that. I went to a regular barber and it didn't work out that right way. And my line is already going back a little bit. Thank goodness y'all can't see that, but you have to separate the needs from the wants, period. So with the financial coaching program that I have, I do help people become financially literate. I had a couple that was out in Florida where we do like Zoom calls. And what I noticed is usually you have a free spirit person and then you have like a nerd, right? With me and my wife, sometimes the role can kind of change. But it's important to have both. So you need to spend your money, but you don't need to spend all of it. And that's where the nerd comes in. Like, we spend too much money on food. This money, we need to cut back. Versus saving the money all the time and not having any fun with it, then what's the purpose of it? But yeah, that was an excellent point when it comes to budgeting. And I feel like that's something that's slept on, because credit is important, but having a positive cash flow is even more important.
Yeah. So when it comes to building a credit, what age would you say it's good to start worrying about your credit?
So this goes back into kind of what we were just talking about when it comes to being financially literate. If you're 18, you can start building credit. But I say it depends on the parent to start teaching their kid about money first before talking about credit.
Yep, I agree.
Because I have parents come to me, hey, my kid's 16, how can I build a credit? Like, well, ma'am, you only have $1 in your savings account, and you just asked me to reverse a fee for you, This is not the type of environment for success for you. And then now you're trying to teach your kid these bad habits. So parents can start helping their kids with their credit as early as 12, personally, where they can add them as authorized users on the credit cards, depending on the bank or the credit card company. I would say for a person if they really want to start, they can start at 18, but they have to have that strong money foundation when it comes to having an emergency fund.
Yes.
If you're young, I think a good emergency fund is $500 to kind of get you started. If you are older than that, $1,000 is like a starter emergency fund. It's not the fully funded emergency fund, just a starter of $1,000. Because what I find is when there's an emergency, usually it's about $500, $600, $400. But 60% of Americans don't have that, especially now with COVID and all this other stuff that came down. It's probably even more than that. So I'm looking forward to see what the numbers are. But 60% of people, so 6 out of 10 people don't have $600 or $1,000 for a rainy day. And from what I've seen, there's been a lot of rainy days lately. Even for me. But you have to have things in place to prevent you from going to a payday loan company. Because what happens is, and as a kid, and I'm not trying to put my mom out like that, but I was introduced to a payday loan company when I was a kid. I was 18. I was eligible. I had a job. I had pay stubs. No credit score, but pay stubs. And I had a parent tell me, "Yo, you can go here if you need some money." I said, "Sweet," But now keep that in mind. What if I took that and ran with it for the rest of my life? Now I'm always paying people, and I'm never saving or investing.
Yep.
So that's the difference between the rich or the affluent and the poor is the mindset. So if you give somebody $1, what are they going to do with $1? If you give a kid $1 and you tell them, hey, it's okay to spend it all, what are you teaching them? If you don't have an account for your kid to kind of split up that money, so for that $1, what do they do with it? They can spend 50% of it. They can save 20% of it. And then they could do something else that extra 30%. Or there's so many different budgeting algorithms that you can use, but including giving. Make sure you give because you can't keep asking for stuff if you're never giving, or you can't get blessed if you're always being stingy. That's just how I feel.
It's crazy because almost every person I talk or listen to when it comes to finances, one of the things they talk about is giving. I listened to his name is Anthony O'Neill. He used to work with Dave Ramsey, if you know who that is.
Yeah, I'm certified through Dave Ramsey's course.
Okay, nice. Yeah. But he used to be like a personality for Dave Ramsey. Now he does his own thing. But he always talks about giving and how he gives to make sure that he can also receive. So definitely, if you have a budget, giving should definitely be a part of that budget too.
Yeah, and that giving, how I do it is a part of my regular spending. So it's not something separate. It can be separate, but it's a part of what I'm gonna spend when it comes to my expenses. But yeah, so to answer the question, what age can I get started? 18, but make sure you are doing well with your money. Make sure you have a savings account. Make sure that you have a checking account that's not charging you fees, because there are banks out there that charge you fees for some of everything. For a statement, if you don't use your debit card 5 times, you get hit with all these random miscellaneous and frivolous fees. So that's my tip, is you can start at 18, but don't rush into it.
So I kind of talked about it with Dave Ramsey and Anthony O'Neill, where they don't really believe in like using credit cards and having a credit, or like worrying about your credit score. They really talk about like being debt free, having
financial freedom.
Financial freedom. That's what their big thing is. So can you be successful without having a credit score, without like worrying about your credit?
That's an excellent question. Now, I did take Dave Ramsey's Financial Peace University. I took that with my wife. The second we got married, I took some of that wedding money we had and we bought the course. We went to the live in-person classes as well as online. So I truly believe his program works, and it does work, and it has benefited me and my family. Now, when it comes to like the credit piece, it just depends. It depends. That's a good question. So I had a situation. There was a guy who came to the bank. He was looking for a home equity line of credit. And for those who don't know what a home equity line of credit is, it's a way to borrow from your equity of your house.
Okay.
So his house is fully paid off. He's retired. He's in his 40s. Young guy. Has $100,000 with us in the bank. Has money in retirement. But his house was worth like $300,000, and he wanted to take about $200,000 out of equity to buy a new property to like fix and flip or fix and hold or whatever. Came to the bank, applied. I'm thinking he will get approved. Man, this guy got 100 G's in his account. He definitely will get approved, because he has assets, but no liabilities. And I said something earlier. You need something reporting your credit for at least 6 months to have a FICO score, right? This guy paid off all his debt, had nothing reporting for years. And what Dave Ramsey says is true. If you pay off everything, you don't use it, it'll close. So his credit score was non-existent. He got declined for that application. So I say that to say it does depend, because you can have all the money in the world and try to rent an apartment and not have a credit score and not get an apartment, just one little room, versus you can write the check and buy the building yourself. So I say it does vary, depending on your philosophy. Some can help you, some can hurt you, but it's all about having a very strong foundation. I know people who are very wealthy who do Dave Ramsey as well as have credit cards in the mix, where they use that for like rewards. Not the rewards don't make you rich, and that's very true. And Dave Ramsey's like a huge proponent. Like, man, you're not gonna be a millionaire off these rewards, but some of these cards do come with perks. Like I was able to take my wife to Vegas on rewards points. Got the trip expense through the rewards. Didn't spend a penny for it, and it was pretty dope. So depending on how you use it, it can benefit you. I would say having a positive cash flow is important. Having that savings is important. But having credit can be important depending on what you're trying to do. And if you're just trying to live in a hole and not do anything, then you're fine, and you have $1 million in the hole with you. But from my experience, sometimes Murphy's Law comes into place where things can go wrong, and they do. What happens when you eliminate all your resources? You have a backup plan. So that's an excellent question. It does kind of just vary, but I would say depending on what you're trying to do, you can be okay without credit.
Now, I was going to say, now with this episode, at least, we're not trying to convince you to go either way, where use credit or don't use credit, you have a credit card, don't have a credit card, and that kind of thing. But whichever path you take, I think is very important to, one, know your finances. So have a budget, know where your money is going, know where your money is coming from. Because with both situations, like that's the foundation.
I was listening to something earlier about if you gave somebody $1 million, like what would you do with $1 million? They would be broke because right now they have pennies or hundreds of dollars and they don't manage it. So how can they manage something that big when they can't even manage the small money? And there's another quote, if you gave everyone, $100,000, or if you made everyone rich, all the money will go back to those who were rich before. And the people who got the money that weren't ready for it will be poor. So having that strong foundation is very important, regardless if you're into credit or not. Just being financially literate is important.
Yeah, definitely. So we talked a lot about credit. We can get a little bit into the banking. So can you give us a small breakdown of like how banks work, and like when it comes to like loans, your checking accounts, savings accounts, all that, I guess mortgages, all that kind of stuff?
So banks are for profit, meaning they're in business to make money. All right. So that's why you see like interest rates on the loans and on the credit cards. And what I've seen is if you do have a good credit score and you are using the bank's money, the interest that you pay is less, versus your credit isn't that good, your interest is going to be higher. So that's one way the bank makes money, is with the loans and credit cards. When it comes to like checking accounts and savings, a lot of banks are going the route of no fees for the accounts, which I think is a good idea, because I worked in low moderate income areas where there are more payday loan companies and more currency exchanges than banks, and a lot of our people, unfortunately, are using prepaid cards and using these other services or non-banking services, and they're paying for it. You want to roll a quarters? Okay, you got to give me $10.50. Like you losing, you could have just went to your bank and just got a even exchange of the coin. So banks are for profit, and that's the difference between a credit union and a bank. Is credit unions are not for profit, and they're more service based on their members. So when you have an account with a credit union, you're a member, versus having an account with the bank, you're just a consumer, or considered like a household. With credit unions, the money that they make, they try to share it across the members. So usually that's why when people get better interest rates at the credit union, is because that's one reason there. The pool of money is utilized for reinvesting in the members, and like 9 out of 10 times you go to a credit union for a savings account, your interest is always going to be better. I would say 10 out of 10 times. CDs or certificate of deposit is going to be better. The interest rates that you pay on the credit cards are not going to be over 20%, versus right now, if you go to a bank, you're going to pay 25% interest if you have okay credit or bad credit. If you have good credit at the bank, you might pay about 15% interest. So banks are for profit, and not all banks are created equal. All right, and I mentioned the story when I was at my second banking job, how I couldn't get approved for a credit card. I asked my manager because a customer came to me, because I'm used to working on Teleline, and the customer said, "Hey, I'm trying to build my credit, and do you have secure cards?" In my head, like, oh, I'm trying to build my credit too. What is this secure card you're talking about? Let me just go to my manager, see, so I can get the answer for both of us. So I go over there and ask my manager, hey, this customer's interested in a secure card. They want to build their credit. And the manager knew nothing about me and my credit situation. And this is what the manager said to me: we're not interested in those type of clientele. In my head, I was hurt because I'm one of those type of clientele as well too. And I'm in that pool of, I'm at the bank, but I don't know nothing about banking. I'm 18, 19 years old. I don't know anything. I'm ignorant, but that hurt. So a piece of advice I would give you is, when I said not all banks are created equal, find a bank that works with where you are with your goals. If you're working on building your credit, find a bank that will help you do that, because not all banks do that. If you're trying to get a house, you're a first-time home buyer, certain banks have first-time home buyers programs where you could get like a grant, and that's money that you don't have to pay back in the form of a down payment. Usually, like the bank I'm at now is like almost $4,000, like $3,600 for down payment assistance. Not all banks do that, so whatever you do, and this doesn't have to be with banking, and this is like my advice for the day: whatever services you're using or utilizing, regardless of what it is, it could be your tax person, it could be your shoe shiner, whatever. If they don't give you advice or answer your questions so that way you can grow, are they really worth your time and your resources and your money? Because what I find is, I can be opening up an account for somebody and they'll rave about their bank. Oh, I've been in this so-and-so bank for 20 years or for 10 years. I said, that's good. You're a lawyer, right? How many times have they called you to do like a financial checkup? Never. Okay. Well, that's the difference between what I'm going to be doing and what that bank has done for the past 10 years. But what they haven't done in the past 10 years is check up on you. You still got that same checking and savings account, and you got Zelle, and you got this ATM card, and that's all you have. What else do you have with it? Did they really provide value, or did they just give you convenience? There are banks out there that can do both. So the bank I'm at now, I love it because they do both. They cater to those who are fluent and those who are working on building or rebuilding themselves. So regardless if a person has a good score or bad score, I can help somebody, period, versus outsourcing them and sending them somewhere else.
So you was talking about credit unions and how it seemed like it might be better to be a part of a credit union than be a part of a bank? Why would someone like? What makes up like? Why would you have a bank account if you could just be a part of a credit union?
So you don't want to put all your eggs in one basket. All right. So you don't want to have all your money tied up at one bank because the system can go down and you try to use your debit card and something happen and you can't use your money. And vice versa, if the company goes down for whatever reason, your money is like insured, but still, do you want to have all your money tied up in one place? No. The pros and cons of credit unions are the pros is you get better interest rates and you get a better yield on your money when it comes to savings. The downside of it is there are not too many locations. You know?
Yeah, that's true.
So that's the downside. So when you're looking to see what is going to be your primary, you have to take that into consideration. I have several different types of bank accounts. Some are credit unions, some are non-credit unions. And I diversify my money that way too. But wherever I'm at, I can find somewhere that I can go to get something if I need it.
Exactly, yeah.
So that's the downside of a credit union is there are not too many locations. And to add another piece to that too, and I didn't see this as a list of questions, is what about banks that they don't have brick and mortar locations? You know, you have like the Capital Ones out there who don't have too many locations, but yet they give you better interest rates, you know, and they have a better lending program. There's a reason for that because they're not paying for the buildings that are holding the employees. So they're saving a lot of money. So that way they can really invest into the products that they have. So that way you can get a better, you know, banking type of situation. The downside of that is when and if something goes wrong, there's no brick and mortar location to go to. You're going to talk on the phone with someone from overseas, or you're going to be talking on like a chat, you know, and you can't physically go in and talk to somebody face to face to get your issue resolved. So that's a pro and a con, you know, wrapped in one. So it's good to kind of have a good mix though overall.
Yeah. Now kind of switching the conversation a little bit over to cryptocurrency. I don't know how much you know about cryptocurrency, but how do you feel about it? And like, how do you feel how it's changing, I guess, the financial industry?
That's an excellent question. And I'm not an expert on crypto. But what I will say is when it comes to how banks look at crypto.
Well, before you go into that, can you kind of explain what cryptocurrency is for someone who might not know? If you can. If I have to, I can Google it.
So basically, from my experience with crypto, it's a form of digital currency. So it's a digital currency that can be easily, and it was made to be easily traded versus going through banks. And there's no exchange of money. You hit a button, boom, you can transfer assets to somebody else. Or you can trade it for other things as well too. So there are companies that are accepting digital currency as a form of payment, which is super dope. The downside of that is right now, the market for crypto is really low. So if you exchange for a Bitcoin, it was like 50,000, you know, and you hold that 50,000 now, it's worth 20, 30,000. So the value is so volatile, and that's what something that kind of concerns banks is, you know, it's so volatile. There's no consistency. Is that something that we can really use? Another issue with like when it comes to how I see banks looking at crypto is banks are heavily regulated. Heavily regulated. I'm talking, I can't give you a penny if I don't see your ID type of thing. Because I have to report any dime that comes in and any dime that comes out. Same thing when it comes to like anti-money laundering, you know, laws. There's so many tests and trainings I have to do every year to be compliant with the updated laws. With crypto, it's unregulated, and there's no regulations on it right now. So if you mix the two with the banking that are heavily regulated and crypto that's not regulated, you're gonna end up with a beautiful disaster, and the criminals are gonna love it. You know, for those who are trying to, you know, get over in the money or wash money or money launder. But like I said, I'm not an expert on crypto. I am a little bit in the market, but I don't have too much to say about just overall crypto. I think it's very valuable. And if you can add that to your portfolio, now is the time to do it. And this is not like financial advice, But I'm just saying, look at where the numbers were a year ago and look at them now. They're really low. So it might be wise to just consider looking to maybe add something to your portfolio.
Yeah, so I wasn't planning on going too deep into it, but I thought I would ask since you are an expert in banking and that kind of thing. But getting back to what the regular scheduled program, when it comes to loans, how do banks usually decide to deny or approve someone? And then if you get approved, how do they decide like on that credit limit?
That's an excellent question. Different banks have different guidelines for lending. Even just for having an account, they have different guidelines on what they need or what they require. And I talked to you about trade lines before. That's really important, is having an established history. But just having a good credit score is just a piece of the pie. It's not the full piece. So I seen somebody get declined for a loan and they had like a 700 plus credit score. And they were so confused. Like, I got declined. I can't believe I got declined. I said, well, let's look at your full report. Let's have a sit down. Let's go over it. How many accounts have you had? How long have you been in the credit systems? How long have you had information reported to the credit bureaus? All of that is taken into consideration. One of the biggest things that a lot of people don't know is what DTI means, and that's debt ratio, your debt ratio limit. What that is if you take everything that you pay that shows on your credit report. So you can take your car loan, your credit cards, your mortgage or rent, and you add that all up and you divide that by your income on what you make a month. So just to keep it simple, if you pay $1,000 a month on your debts and your liabilities, and you make $2,000 a month after taxes, 1,000 divided by 2,000 is 50%, meaning your debt ratio is 50%. What does that mean? That means 50% of your money is going toward your debt. That's not a good thing.
You still got to live.
Yeah, you ain't got no gas, So a good number to kind of have your debt ratio is when it comes to like being lendable is like 30%. Having your number around 30% will kind of get you in the door. But I've seen people get declined for that all the time. Is not having their finances in order, and they're trying to get more, and the banks look at them as high risk, and basically, if you look at what a credit score is, it's a debt score. How good are you at paying back your debt? Think about it like that. If you have no debt, you have no score. If you have a lot of debt, you pay it off, you have a good score, but you have to think about too of like the opportunity costs. So if you go and get a car when you're 18, you're paying $400, $500 for that car, and you're 18 and you're barely making, $1,000, that's not a smart financial decision. Versus if you were to take that $500 and save it or invest it, now you're utilizing compound interest. And this is like another piece of advice: interest that you make is a reward, interest that you pay is the penalty.
Yep.
So I literally talked to a young lady. She was trying to buy a car. She was super excited, and I'm not trying to discourage anyone from having that. If it's your dream, sweet, but I just want to at least let you know of the pitfalls. You're 20 years old, you have no liabilities, you pay off your credit card in full every month. Now you're trying to get a $30,000 car and you only make $30,000 a year. Does that make sense? No, it doesn't. So I broke it down to her. I showed her the differences from going to that lot down the street, where you're $500 down and you instantly approve, and you pay 18% interest. What does that look like? Versus doing it the right way, paying cash, or going through a credit union or bank and paying 5% interest. That's a huge difference. So yeah, that ratio is huge. Sometimes the collateral that they look at as well has to be eligible too, meaning like certain banks have it where if you're trying to get a home equity loan or home equity lending, the property has to be a specific property type. Like if it's like a mixed use building or commercial building, it's not eligible. If it's an investment property, sometimes it might not be eligible. But there, like I said, there certain banks have different criteria. So you can go to the other bank down the street and they might lend to investment building, properties. So it all goes into consideration. But what I find is with the banks, usually it's black or white, meaning you got this or you don't. There's no in between. What I've seen with credit unions is usually they have one person in charge where they can make that overruling decision, where they look at everything, paint a picture. Okay, I'll put my stamp on it, and boom, you got it. But don't just think that credit score is important, because it is, but it's not the full picture.
Now, when you was talking about debt to income ratio, I don't know how. When it comes to student loans, is that different, or is that like?
It depends.
Okay.
Basically, what I said was anything that you're actively paying on a monthly basis that shows in your credit report. If your student loan is in like a forbearance period, it's not counted. So you will see that deducted from what you would pay on a monthly basis. Because right now, every month they report how much you pay a month. Right now, you're not obligated to pay anything, even though it shows in your report, it's not counted toward that number. So when you're trying to get a house, that is something that the mortgage companies look at too, is when you have to start paying that student loan, will you still be able to afford the house? So that's an excellent question. And that I have had people get declined because all they had was student loans on their credit report, nothing else. And as I said, sometimes you need like an active account showing history currently, and they had none, even though they had several accounts on their credit report.
I think you may have answered this question already, but I asked just in case there might be new information. But what are some good reasons to take out a loan or a credit card, and what are some not so good reasons of doing?
That's an excellent question. So there's a book that I recommend. There's a few books I recommend, but this book here is Rich Dad Poor Dad, where here Robert Kiyosaki teaches you the difference between an asset versus a liability. Now, if your life is just revolved around getting liabilities, then you're gonna, you won't ever be wealthy or rich or financially free, because you're always tied
to something,
paying something back.
Yeah.
And how I look at it is like this: how many hours do I have to work to pay that off or make that payment? I don't just say, how much do I have to pay or how much do I have to pay overall. That's another important question. How much you have to pay overall, not just a monthly payment. But now breaking it down to how many hours I got to work just to pay this thing. But when it comes to making like a good decision, when it comes to getting a loan, let's say you're trying to buy a house. There's nothing wrong with buying a single family house. That's a goal that a lot of people have, and they, it helps get to that point. But if you have other liabilities as well, in addition to that house, now the house that could have been an asset is a liability. My take on liabilities is versus assets is if you have to pay for it out of your cash flow, it is a liability. Meaning, if you work a job and you have to take a piece of your money from your job to pay this off, it's a liability. Meaning it's taking away from you. Versus an asset, if that is a 2-unit building, and the person on the top floor is paying off the property for you monthly, and none of your money goes to that, that's an asset. So in my case, that will be a good loan to take out, when it comes to making a smart financial decision. Getting a property that pays itself back. Same thing with the car. You can get a car, usually cars are always liabilities. We took our car recently and had it wrapped. We had a company pay us to wrap our car and just drive around. So the amount of the wrap that they were paying was more than my car note at the time. So I took my liability and made it into an asset.
Does ride shares and like renting out your car, would that be considered?
If you're not paying for it, and after that is done, whatever your car is being utilized for is done, and you make a profit, or you break even and you don't physically pay anything on it, I think that's a win.
Okay.
Yeah. And you can kind of just work on how to make that vehicle or that asset more profitable. But that's another way to turn a liability into an asset is, putting it in place to make money and have other people use it.
Yeah, definitely. So as we kind of gear down this episode,
you said something about credit cards too. About when is it smart to take out a credit card?
Yeah, okay.
Yeah, this. I've seen this a lot too. Look at the fine print on the credit card disclosure, like the terms in the agreement. They tell you everything you need to know. People get so happy with applying, they apply, and they never look at none of the paperwork that comes with it. Usually you have to look at it, and it will tell you what the annual fee is for the card. So if you have to get a card and there's an annual fee, is it really worth it just to have that card? Now, there are certain cards that come with great rewards that have high annual fees, and it might benefit you. Also look at the percentage of the interest rate. On like the third or fourth line on the terms agreement, it says how to avoid interest. They tell you right in front of your face, and you never look at it. And to avoid interest, whatever you use on your credit card, pay it off. Simple as that. Whatever you use, pay it off. So if you use $500, the bill comes, pay $500, you won't pay any interest. So regardless of what the interest rate is, you won't pay interest if the loan or the credit card is paid in full every month. Now, a smart way to get a credit card, or a good way to use a credit card, is if they have 0% interest for a specific time frame. Now, this is if you are financially literate, because what tends to happen is people get this 0%, they max it out, and they paying 0% on it for 12 months, and them 12 months end really quickly. And now you got the bills that you had before that, in addition to this new bill, and now you're in a rat race where you're trying to find a different credit card to move that money from from the old credit card, and you're on a downward slope, and that will really hurt you. So there are companies that do 0% interest. Sometimes you have to pay for a balance transfer, and for those who don't know what a balance transfer is, because I see this a lot, is if you owe one bank $500 and you're paying a large interest rate, and you want to pay no interest, a different bank will offer you a balance transfer promotion, meaning that you take the money that you owe from this bank in the form of a credit card, move it over to the new bank, and pay no interest on it. And that's
for a certain period of time.
Yeah, for a certain period of time. And that's what a balance transfer is: moving the balance from one credit card to a different company, so that way you can have a better interest rate. And you're basically consolidating or reconstructing your debt.
Now, you were just saying about like making sure you pay off your credit card every month. If you're paying it off every month, you're not paying any interest on it, does it still help you with your credit score, or do you still get the rewards that comes with that credit card? So
you get the rewards regardless.
Okay.
There are certain companies that offer you rewards when you use it, and they offer you rewards when you pay it back. So using the card is one thing. Now, there are 1,000 different myths on how to build credit, or what's the proper way to use the thing. My thing is I always try to think financially. Like, is this a smart financial thing to make? And I mentioned earlier, interest that you make is a reward, interest that you pay is a penalty. So if you have the means to pay it, pay it. I've seen credit reports that have people who have 700 plus credit scores, and they never pay interest. Versus the myth, pay only 30%, and slowly knock it down every month. No, that's not necessarily true. Now, when it comes to how banks look at it, is banks love to make money off you. Like I said, they're for profit.
Yep.
So if you don't use your credit card and you ask for a limit increase, they're not going to give it to you. Why am I going to give you an extra $5,000 if you haven't used the first $5,000 I gave you, right? Versus if you use the credit card and you pay interest on it, but you only pay a little bit on interest, the banks like to okay, they're responsible, but yet, they help us out too, with our bonuses and all that stuff. Why not give them an increase? But on your credit card statement, like when you use your credit card, you're going to see 3 different options to pay. You have the minimum payment, which I don't recommend pay the full balance. The next thing is the statement balance. So the statement balance is a 30-day window of when you use the card. You're only obligated to pay the statement balance. So let's keep it simple with math. Let's say you have a $500 limit credit card. you used $100, right? That means your minimum payment is $35. Your current balance for that 30-day window is $100. But what if a day after you use the card again for another $100? So you owe $200, but you're only required to pay the first 100 because that's what is going to be reported to your credit report. So pay the statement balance in full if you're going to use your credit cards, and that's the smart way to use it. And I've seen people with great credit scores and money in the bank do it that way, where they have everything come out their credit cards that are recurring, and they get all the rewards and the points for it, and then they pay it off in full. So to answer your question, even though you pay your card off in full, you're still getting rewards. You're not paying any interest, and you still have an open trade line. So it's a win-win situation doing it that way.
Only if you are financially responsible.
Only if you are financially responsible. And I've seen it where people aren't, and they get started, and then, like I said, that Murphy's Law kicks in. They don't have that emergency fund, or they depleted their emergency fund. And here's how that downward spiral looks. You max out all your credit cards, right? An emergency comes, you have no room on your credit cards to help you with that emergency, right? You use your savings account. Hopefully you had $1,000 in your emergency fund. Now, what a fully funded emergency fund is, just for those who don't know, is 6 months of expenses, 3 to 6 months, meaning add up everything you pay every month. I'm talking the giving, the Netflix, everything,
food, gas,
everything.
Yep.
Add it all up. If it's $3,000, times that by 3 or 6, and that will give you what your cushion is. So what happens is they have no emergency fund, they deplete it, then emergency comes. Now they're struggling. Now they tend to overdraft their account, or they go to a payday lender, right? Which is already the devil.
I used them before, and
I did
the
too.
worst thing ever. I would never go. I would live in my mom's house before I go to that again.
400% interest.
Yes.
Never seen anything like it. I'm like, what's that? That's a high number. The higher the interest rate, the worse it is for you if you have to pay it. Versus if it's a savings account, you want a higher interest rate. But now they use a payday loan company. They're already in the bind, right? They get paid. They have no money to themselves. All the money goes toward their debts. And then they need more money to sustain their regular lifestyle. And it's an unending spiral. And that's how people really get hurt when it comes to credit, is they don't have that strong foundation. Stuff happens. They utilize all the resources and all their credit, and they end up bankrupt.
It's crazy, but it's true. But before we end this episode, I have one last question I want to ask you before I get to like the final questions I ask everybody. But where do you see the financial industry going, or banking industry going in the future?
That's a good question. That's a really good question. I worked at banks that were modern, and I worked at banks that were very old school and traditional. When COVID happened, a lot of companies realized a couple different things. Is we can have people work from home, or we don't need that many people here. All right, we need to be more efficient. And when they use the word efficient, that means it's like lay people off. So what I've seen is banks are cutting back. They're closing locations. They're utilizing less people, and they're investing in technology. When I say technology, I mean everyone here has a mobile app on their phone, and you can do almost everything there. You can deposit your check. You can send money out, wire transfer. What do you need to go to the bank for? And then when you go to the bank, they have those smart ATMs. Now, traditionally, an ATM would give you like $500 and call it a day. These banks give you like $1,500, $3,000 limits at the ATM, meaning they're driving you toward the ATM instead of going inside the bank. So I can almost guarantee that many of these people that listen to your podcast don't know the name of their banker. They don't know. Every time I open an account, I ask them, hey, what's your banker's name at this bank that you're so loyal to? I don't have one. Oh, what's her name? I have a card. When the last time she called you? You know, but just banks are, in my opinion, will eventually eliminate the teller role, and have bankers there that can do both. I've seen it happen at the bank I worked at before, where there were like several of us on the teller line. Once they invested in the technology, they had me greeting people, pointing them to the technology instead of helping them with their teller transaction. Went back to that bank. The teller line is almost eliminated, and now they have 3 more machines inside, which is weird, but very efficient. Because why pay a $40,000 salary for the next 20 years when I can invest $100,000 now and be done with it and just keep it up? So it's a smart decision, when it comes to financially wise, but you have a lot of people that want that warm, interaction with a human. Even look at the stores you go to. Go to Walmart, go to Target. What do you see now? Scan it yourself.
Yeah. Like even at CVS, which is crazy to me.
I went there, same thing. I saw it, and it was really nice. But that's where a lot of companies are going, because the number one expense for companies
are their people, employees,
salary. How can we lower the salary? Get some machines. So I don't know when, like how quickly that's gonna kind of come to fruition. But that's just what I've seen, and I've been in banking for 10 years, and I've seen that already. Having less people doing more work, and having the technology to help up with everything else.
It's crazy. So before we end this episode, but last 3 questions, I promise. What I'm trying to say? First of all, do we miss anything that you think we should have covered through this episode?
We covered a lot.
Yeah, we did.
I would say that financial literacy part is huge. So being financially literate, that's one thing. Knowing where to get your credit reports. Also knowing what company will benefit you when it comes to whatever you're going to do. Like I said, it could be taxes, it could be this or that, whatever, especially banking. If you're not going to grow from this relationship, because it's a relationship, right? You give and you take, and you're supposed to grow and benefit from it. If you just have a checking account and a savings at the end of it, and they're not helping you with your goals, are they the right bank for you? Even though they've been good to you, in your opinion, for the past 10 years. So, and that's just with ending, like I said, if it's not going to benefit you and help you grow and help you level up, is it really worth it? So that's like the biggest takeaway right there.
And then that actually kind of goes into my next question, which is, what is 1 or 2 things that if they don't take away anything else from this episode, they got to take away these things? What is that?
That's a good question. Just saying it again, being financially literate, knowing where your money is going, how much is coming in, how much is going out, telling your money what to do before it tells you what to do.
I like that. I'm gonna have to write that.
And that's not mine. I took that from somebody else. So you can put, whatever. But I would say that's really important. Credit is important, but don't make it the number. Yeah. It is important, and it's a part of the financial picture. But if you have no money and you have good credit, is it worth it? Yeah, then I can use more credit, give more money. But versus having consistent, or a nice foundation in addition to credit will definitely help you. Dave Ramsey talks about that, all the time. Or he does you credit, you stay away from it. What happened to him? He became bankrupt, lost all his properties. But he utilized it before to get to where he was before. If you do things differently and learn from other people's mistakes, you can benefit from it. And that's why I love working at the bank, because I talk to so many different people on a daily basis. Millionaires, like there's a book, The Millionaire Next Door. I talk to a millionaire like every other day, like, hey, and I ask them questions like, hey, how did you get to where you are now? People who buy and flip property, I ask them all the questions like, hey, what got you into it? Like, for someone who is interested in getting to that field, what do you think they should kind of worry about or focus on? And I get the answers right there, So I love working in banks because I get to get that interaction from people. And what I would say is, don't be afraid to ask questions, period. So if you're applying for a loan, or you're applying for something, or you're trying to get something, whatever, ask questions. Even if you're in the hospital, ask questions. Before you take a a pill or a shot.
Yeah, definitely.
Just ask questions. That's it. Ask questions, and if the person can't answer them or answer them to your comfort level, is that the right person, or is that the right place for you at that time? Probably not.
I agree 100%. But again, before we go, I would like to say thank you, Alex, for coming out and giving this great information that I've learned from, and hopefully you learn from, listeners as well. But before we go, is there anything that you would like to shout out, anything you like to plug, or anything like you want people to contact you or anything like that?
Yeah, so for sure. For those who want to follow me on Instagram, my Instagram is The Credit Banker. It's the only one, The Credit Banker. If you're trying to find me on Facebook, you can look up Alex Rubio, a big guy with a suit and the glasses and like a quirky smile. So those would be like the best two ways right now to reach out to me. So if you have any questions, you can reach out to me there. If you want to email me, my email, I can give it to you as well when it comes to like the business aspect for like coaching or credit is going to be info@rubioscredit.com. So info@rubio, RUBIO, rubioscredit.com. All right.
Do you have a website or anything?
I don't have a website right now. Yeah. Okay. I probably have to invest into that.
Well, whenever you get a website, let me know, and I can also put that out there too.
Appreciate that, brother. Thank you.
Yeah, again, thank you for coming out, for sharing this great information. It's definitely going to help somebody build their wealth and be successful at whatever they want to do. And then to my listeners, thank you for listening in. I hope you really grab something from this episode that you can use right now for your life. But as always, until next time, continue your journey until you reach your success. Thank you for taking the time to listen to this episode of the Lazenby Experience podcast. I really hope you were able to receive valuable information that will help you take actionable steps to get you closer to achieving your goals. If this is true for you, I would really appreciate it if you share this episode with others, comment your thoughts, and subscribe to continue receiving updates on new episodes. I truly am excited about how my experience, the Lazenby Experience, can make a difference in your life. Again, thank you for listening to the Lazenby Experience podcast, and until next time, continue your journey until you reach your success.